Last week, the stock markets were waiting for Nvidia to come out with its earnings. So we saw a little bit of calm before that happened. The US market ended up slightly down on the week. The Canadian market actually fared quite well. It was up 0.8%. That was largely because the Canadian banks did extremely well. The energy sector was positive, and gold miners. That triple combination really helps the Canadian stock market overall. But on Friday, we did see a report come out in Canada that showed that the economy is not so good. The report that came out was the GDP growth annualized. It came in at 1.6% negative. Now I want to show you this here. So 1.6, the expectations were for negative 0.6. So the GDP was even worse than expected. And 2 negative quarters is the official definition of a recession. We'll have to see what happens next quarter. There were a lot of reports out last week that said that it was the trade war that was causing the problem, crushing exports. Yes, it probably had an impact, and you go through the numbers as well and say, yes, it had an impact. But the Canadian economy had been slowing down before all this. The trade war is only complicating things. It's making things a little bit worse, for sure, but it's not the root cause. Canada is stumbling at this point. On a positive note, we saw the Canadian banks perform extremely well last week on their earnings overall as a group. And this helped to push up the bank sector prices, which was a positive for the stock market. Getting to the US, this is a meme that I saw, Nvidia, and holding up the global economy. So we had a lot of investors waiting for the Nvidia results on Wednesday after the bell. Nvidia represents approximately 8% of the S&P 500. That's a huge amount. And it's really been driving a lot of the sentiment for Nvidia and the markets overall. Now, we saw Nvidia come out with fairly decent earnings overall, beating expectations like they have in the past, except for the data center growth was a little bit below expectations. Now, just to put this in the backdrop, if we go back just over a week ago, we saw concerns around Palantir is trading at around 95 price to sales ratio, not earnings to sales. And investors started to wonder, well, maybe this is getting a little bit rich. And we saw Palantir take a hit. And we're seeing that with some of the high-flying stocks right now. And basically, we're going to start to see this argument, I think, play out, that back and forth, that trees don't grow to the sky. And Nvidia is saying, well, we got a huge runway for AI to go forward. And that's, we see huge growth for the company, and our stock prices justified, and then some. But on the other hand, if Nvidia keeps growing at the rate it is growing at, let's say over the next 20 years, well, it takes over the universe. So where does that inflection point happen where it's, that's too much, trees don't grow to the sky? So I think we're going to start to see these arguments take place. Here's an analyst backing up Nvidia's claim that projection of 3 to 4 trillion in annual AI capex by 2030. Those are huge numbers. And a lot has to go right for that to take place. Now, there's no question AI has been dominating the narrative for quite a while. We're seeing a lot of articles like this saying AI adoption linked to 13% decline in jobs growth for young workers. Now, if you take a look here at the types of jobs we're talking about, it's customer service representatives. So a lot of them can be taken over by AI, as an example, accountants, software developers. So there's no question there's certain types of jobs that are definitely vulnerable to being taken over by AI. And we are seeing that happen, particularly in the technology industry where they're using AI themselves. The big question is how far can AI make inroads into other types of industries? This is an argument on the other side. This is saying that 95% of generative AI implementations are finding no measurable impact on P&L. That's a problem, because if you're finding the customers and general businesses aren't finding a huge impact on P&L, they're not going to commit to getting more AI or implementing more AI, which will roll back to actual expansion of AI into CapEx. So these are some of the nuances that we're looking at right now. We're going to see a lot more battering around of these concepts and saying that AI is going to take over the world, but how long is it going to take, etc. No, it's not. So we will see more of this happen. And we'll have to watch out what happens overall with the technology space, because this has been driving the whole technology space as well. Okay, so let's take a look at the numbers for the U.S. last week. In the stock market, here's the S&P 500 was down 0.1%. Energy was up 2.6%. This definitely helped the Canadian market overall. We saw industrials down 0.7%. Technology was flat for the week. Last week, we saw the TSX up 0.8%. That was largely the result of the Canadian banks doing well, the gold miners doing well, and the energy sector doing well. Interesting to note, the European stock market was down 1.9%. That's a huge downdraft for this stock market. Now, earlier in the year, we saw the European stock markets actually outperforming the US and Canada, because we saw this knee-jerk reaction to the possible tariff situation where we saw large institutions pulling money out of the US, and that was benefiting countries in Europe. But that seems to have changed. We're starting to see, the economic policies in Europe are they're not very good. The economies are really struggling at this point. France is possibly, we could see the French government seek IMF help. They're talking about this publicly. The government may collapse there as well. UK is an absolute economic mess. Even German yields are moving higher. So we're seeing a lot of the weaker economic policies in the EU starting to play out. And so we did see the European stock markets head lower last week. I want to show you this chart here. So what we're looking at is the 30-year bond yields. And in green here, that's the US. And so that's right here. So we have seen the US 30-year bond yield heading higher. But so if you compare that to countries like the UK, so here's in red. This is the UK here. Above 5%, it's gone. This is a really fast move for UK. They're really being challenged on economic policies. The government has been absolutely wasting money, bad economic policies, et cetera, and they don't really seem to be really caring that much about it. And so the confidence of this government seems to be faltering at this time. But the story here is investors saying, well, we don't trust these governments, not just the UK, but in particular the UK. We don't trust these governments to spend properly, to get their finances in order, to stop throwing money away and spending money, et cetera. And so what we're seeing is yields on the 30-year, so the long end of the curve, the central banks really don't control, rise. And that's becoming a problem, because a lot of these countries have huge debt, government debt. And it's going to be very expensive to finance. If you take a look here, in red here, this one here is France. So you can see France just really recently actually going up quite a bit. This is becoming a little bit of a problem here. Canada in here is the light green. So we are seeing Canada. We have been fairly flat overall, but Canada is ticking a little bit higher. The other one is really important here is Japan. So this deep purple line here, okay? So this deep purple line has been rising from almost 0% and going higher and higher and higher. This is a problem at 3.19% for the 30-year. This is a huge problem internationally. I know North American investors don't look so much at the other markets, but if you take a look, this is really unwinding the yen carry trade. And as well, if you're an institution in Japan, you're saying, well, before we used to get around 0. So why would we invest there? We'll flip our money into US dollars. We'll go invest in the US market and we'll get our returns there. And we can always come back to Japan if we need to. But now, as far as an opportunity cost goes, well, they're going, we can get 3% in Japan. So why would we take all those extra risks as far as leveraging out into the US goes? This actually might ripple around the world a bit more than what people expect. So it's the bond market that I find is problematic at this time. I've done a video on this and really focused on this. Most investors aren't interested in this so much because it's international, but it is something to watch out for. Okay, so here are some of the subsectors in the market. Here's gold miners up 5%. In this case, we had metals and mining up 2.7%, gold up 2.3%. When both of these sectors are up, this usually helps the gold miner sector. But this is a strong move for gold miners and also gold as well. We'll talk a little bit about that in a second. We saw uranium up 3.1%. It starts its strong seasonal period coming up shortly in September. And the World Nuclear Association starts their conference the first part of this week. So this is a positive thing and tends to drive the sector higher. So we could see some returns. We'll take a look at that in just a second. Okay, I'm going to start adding natural gas into that subsector allocation there, or graph, because it's starting a strong seasonal period this week. And we should try and track that a little bit. Now, we did see that move last week for natural gas. It started to head higher. It did bounce from an oversold position on the full stochastic oscillator basis. And also as well, the RSI, although it didn't reach oversold, has moved back up to 50 now. You're expecting really to see in this range during its strong seasonal period. So it's from September 5th until December 21st. If we go back here and take a look over the last couple of years, we can see here that natural gas did well in that period. And here we can see the same thing. It tailed off early though in November. So you have to watch out. It can end early, but on average, it's usually around mid-December for natural gas. One of the reasons natural gas is doing well is we're starting to see a change in the inventory levels for the US. So this is over the last 5 years, this EIA data here. And the bands are the maximum and minimum over the last 5 years. The black line is the average, and the blue line is where we are for 2025. You can see here that we're starting to inflect perhaps lower and perhaps going to cross below that 5-year average. We saw that cold spell recently perhaps turn on some furnaces driving the natural gas prices higher. We'll have to see if this bounce can be sustained at this point, but we are starting the strong seasonal period for natural gas this week. Okay, so this answers the question of why gold miners are doing so well. If you take a look here, gold prices versus mining costs, and this is compliments of Crescat Capital. These blue bars are the all-in sustaining costs. So what does it cost to produce an ounce of gold? And it's just over $1,500. But you can see here, the gold price has moved higher. So this is the margin for gold. The production margin is absolutely huge and getting higher. So some of these gold miners have become just cash flow machines, just pumping out cash at this point because their costs are fairly low and price keeps going higher. So why did gold move higher? Well, if you take a look at this graph here, there's all the rage last week. It was showing that gold holdings as a percentage of foreign reserves for central banks are in gold here, and the blue line is US Treasuries. Look what's happened since really 2015. The amount of treasuries held as a percentage has been declining. Gold has been going up, and look what we saw here. We saw a crossover. So at this current time, central banks, as far as foreign reserves, own more gold than they do US dollars. That is huge. We haven't seen that really since 1995, and we still see this line climbing higher. Just as a footnote, Canada has 0 bars or ounces of gold as a percentage of its foreign reserves. Nothing, 0. And that was finalized in 2016. I'm not going to get into who did it and when and all that sort of stuff, but it is important to know Canada has no gold. A lot of investors have been looking at this graph here, long-term for silver here, and going back really into the late 1970s, into the early 80s. We saw this cup situation here, and this is called a handle. It's supposed to be bullish for silver over the longer term with that breakout above. I'm not sure that prices from 44 years ago really make that much of a difference. I think it's more important that it's just broken out to an all-time high. So last week I actually did some videos here. I just want to put them up so you can take a look. Please subscribe and like the video to help grow the channel, and also as well so you can be notified of when these videos do come out. So last week I did do a video on silver set to make a move higher in September, and I talk about how September is a strong month for silver, and now we've just had that breakout take place. I also produced and put out a video on natural gas set to move higher. And I talk about the start of the strong seasonal period for natural gas and go through some of the seasonal figures. So if you want to take a look, please take a look on my channel. I also put out a video on the metals and mining sector. Now, the metals and mining sector typically doesn't do well this time of year. It has been doing well, which is indicative that the sector actually has a little bit of strength here and could continue to do well. But I also talk about some downfalls with the sector overall. So definitely something to check out. Last week I also did a video on gold. gold volatility. So something a little bit different. And I compared price, which is in this gold line here for gold, and then the volatility in the white line, and took a look at the relationship over the past and what to expect. And I talked about how we could start to see gold volatility move higher at this point. Okay, that's enough of me plugging some of my videos in my video channel. But if we take a look here with the technology sector, I've talked about this in the past, and investors don't like it when I talk about the technology sector. The technology sector typically doesn't perform well in September, so that's why I'm bringing this up here. And we are seeing this rounding out motion for the technology sector. It did not perform well last week overall. And we're seeing this happen as well relative to the S&P 500 as well. So when we see this rounding out take place, it usually leads to it. We don't often see a huge, all of a sudden, break higher. We start to see either further consolidation or start to see the sector start to fade as far as strength goes. And if we take a look here, we have seen here price actually fairly flat or moving a little bit higher. But look at RSI. RSI has been moving lower as well as the full stochastic oscillator. So we are seeing that divergence between price and price momentum. So this sector is going to be one to watch in the month of September, which tends to be one of the weaker months for September, especially given what we've seen with what's Palantir's performance. Nvidia, the response to Nvidia a little bit negative overall. So we could start to see the sector actually pull back. We are seeing investors roll into other sectors of the market, such as the metals and mining sector, the gold sector, etc. But it is interesting to see what's happening with the technology sector and if further erosion for this sector is going to take place. Here's the uranium sector. We saw a huge, strong run really from April into July for the sector. Did extremely well, and it's really been consolidating. It feels like it can be a little bit lumpy here. Investors in the sector can get a little frustrated, but this was a huge move, so it's natural we can see some consolidation taking place. There's never really any bad news for the sector. We just keep getting better and better news for the uranium sector overall. And if we take a look even relative to the S&P 500, we're seeing this more of a consolidation phase taking place. Now, I do want to say that sideways, the price has been moving sideways here, and price momentum has been declining. So it's something to watch out for. But watch out for a break above this box or below. But given that we're starting in the strong seasonal period very shortly, we could see this actually break above to the upside and get another run from here. I do want to talk about the energy sector. It's done really well over the last couple of weeks here. We can see that on an absolute basis here. I'm using XLE in the States. And if we take a look here, we see this strong run relative to the S&P 500 now. It is becoming overbought at this point. Now, we are in a strong seasonal period for the energy sector, but it tends to be a minor strong seasonal period. And when we get into October, we can see the sector falter a little bit. So we'll have to watch what happens. We could see it still move higher. It has been doing well over the last few weeks, but something to be a little bit careful with. So what are the market movers going to be this week? Well, let's take a look at Canada. And you can see here that the unemployment report on Friday, the previous July report was for 6.9%. It's expected to move higher. So the unemployment rate is expected to move to 7%. I think once we get closer, if it keeps going, we get closer to 8%, I think that's when people are going to start to really get worried, and we're going to start to see a pullback on expenditures, etc. And we are trending higher fairly steadily for the Canadian unemployment rate. If you take a look here as far as job growth goes, the previous month for July, we were down almost 41,000 jobs. We're expected to actually produce 10,000 jobs. Now, I want to have a warning about the Canadian numbers. They tend to be really, really lumpy. It's just the way it is, the makeup of the country and the size of the population, all that sort of stuff. So you can't really read too much into one number, even this last number being down almost 41,000. But it's still going to be interesting if we come in below this number, and let's say we have another negative number, that won't look so well. It's a really busy week for the U.S., a really busy week as far as economic reports. But the key reports are going to be on Friday. In his speech at Jackson Hole Symposium, Powell made a pivot. And the pivot was, he said that the labor market was now the focus of the Federal Reserve. Now, in the previous month, he had said the most important thing, and so did many of the other governors, was inflation. And inflation was too high, and they had to remain with the tight monetary policy. Now, he's saying the Federal Reserve is focusing on the labor market and not so much on inflation. That's a huge pivot. And If we take a look here at some of the numbers here, we can see here that the previous month was 73,000. I do want to point out the revisions here were down, or negative 256 or 258,000. So we saw this huge revision down, and we saw a weak non-farm payroll number. I'm not going to get into the politics of what happened and all that sort of stuff, but this is definitely the focus. The expectation is for another 75,000 or 75,000 jobs, which is weak, very weak. These are not numbers of a strong economy. Really, you want to see around 300,000 jobs being created, and that's not the case. So these are not strong numbers here. The unemployment rate, if you take a look here, was back in, for July, was 4.2%. It's expected to move higher to 4.3%. This is still extremely low by historical standards. Now, the problem is so many of the other labor indicators are actually quite weak, and so Powell's trying to de-emphasize that unemployment rate. Okay, this chart here is the U.S., and you can see here that it's showing the current federal funds rate at 4.5%. These are the expectations based upon probabilities in the futures market of the Federal Reserve cutting its key financial interest rate on September the 17th, which is not that far away. The chances of a cut are now 88%. This has actually moved back down, lower a little bit. It was up to 95%. It's moved back down here a little bit. I'm not sure at these levels here if it matters that much, but we're not seeing much of a change as far as that goes. If we take a look at Canada here on the right-hand chart, we can see that its current rate is 2.75%. So it's actually quite low. But look at this. The probability of a cut is 55% on September the 17th. So they're going to be making their announcement on the same day as the Federal Reserve. And the chance of that is 55%. Now, I do want to say, just over a week ago, the chance of a cut was 33%. But after that very weak GDP number, the odds of a rate cut have moved to 55%. The earnings season is winding down right now for Q2. There's not a lot of large companies reporting earnings this week. I think the economic reports are going to be really, really key here. The U.S. has a lot of economic reports coming out this week. I didn't go through them all in the video, but the most important economic report is probably going to be the non-farm payroll number coming out on Friday. Now, if it comes in at 75,000 jobs being created, that's a really weak number, but that's the expectation. It's not a sign of a strong economy, but that might help the market overall say, well, at least we're coming in as expected. The danger is if the report comes in with a much lower number than 75,000, let's say 25,000 or zero. The initial thinking may be that the Federal Reserve will be more likely to cut, and that's a good thing. But on the counter side of that is that that's a really weak number for the economy. And people might start to get concerned that the economy is actually slowing down. And it doesn't really matter if the Federal Reserve cuts or not. The economy looks, if we see those weak numbers happen, and that narrative picks up, they may believe that the economy is going to continue to head lower, and that would not be good for the market. There's a lot of narrative talk around whether the interest rate cut from the Federal Reserve tends to push the market lower or not. You can see this in the media a lot, some reports coming out, I'm sure. The Federal Reserve cutting rates does not cause the market to go down. It's a symptom of the expectations of a slower economy. So that's later on in the month, that's September the 17th. We're still a couple weeks away from that. But if we see a number that's too strong and the non-farm payroll number comes in at 300,000 as an example, that's going to really decrease the odds that the Federal Reserve is going to take an aggressive stance in cutting rates. And the market may not like that at all. And if we see a number that comes in too weak, that could be a little bit of a disaster as well. So I think the number really has to be on at 75,000. But 75,000 is not a good number. So I don't see the market having a huge upside potential as far as a possible narrative coming out of the non-farm payroll number. There's a lot of other economic reports, as I said, that could move the markets earlier in the week. And a lot can happen this week as well. But the focus will probably be on Friday. It's going to be interesting once again. And please like and subscribe to the video. Thank you.